right, good morning, everybody. Looks like my microphone is working today. And so far this morning, we are down in the pre-market from 404.70 at the close of yesterday to currently 403.43. So there's a couple reasons why the stock market could be down right now. We just had the core PCE, which came in at expectations. 4.4 versus 4.4 expected, and this is down from 4.7% last month. I actually took a couple of trades on this, assuming that it would come in slightly higher at 4.5, but looks like Wall Street got it right again on this one, where it fell by, roughly that 6%, the same that we saw for core CPI previously. So, with that being said, I think that the markets are going to be neutral today. Personally, I don't think that it's going to be big in either direction based on, the big news of core PCE. And then we also had personal income and personal consumption coming out. So personal income, how much people are spending, actually went down. Personal income, how much people make, went up by 0.2%. So people aren't getting as much as they were getting before. It was like 0.4, 0.5% a month more than they were making the month previous. So if you annualize 1.002 to the 12th power, that means that inflation gains, or wage inflation, is starting to reel back. Before this annualized number was something along the lines of 4 to 6%, so it's good to see this moderating. That means that the job market is more in balance than what it used to be, but it's still pretty rough based on what we saw in the latest jobs report, where there was many less initial jobless claims than what was expected. It was like 1.8 was the actual number versus like 2 something, like 2.1 or something was the expected. And then you also have personal spending and personal consumption down for the month. So personal spending was down 0.2%, while wage gains were up 0.2%. So even though people are making more money, they're not spending as much, so people are saving money. And real personal consumption came down to 0.3%, negative 0.3%. So that means overall there's less spending going on in the economy. On top of that, you have core PCE coming in at 4.4, which is 2 times what the Fed wants. So if you head on over to my Twitter page, this is what I tweeted this morning. And my kind of consensus on this, core PCE came in at expectations. Personal consumption came in subpar, and inflation is still double the target. This is what you call stagflation, where the economy is moderating or seeing very moderate to slow growth, if any growth at all, while you also have high inflation, right? So the Fed wants it at 2. Currently it's 4.4, so it's much higher than the Fed wants it. Also tweeted this yesterday, this morning, Fed pivoting to 25 basis point in February seems very familiar to the actions of the 1970s that led inflation to persist for 10 years. So I think that them letting off the pedal on the interest rate hikes is bad. It could lead to higher spending in the economy. If people, if the stock market starts to go up, then psychologically people feel like they have more money to spend. And overall, it wouldn't be great in terms of inflation. It would be great for investor portfolios, but not so much on the inflation front, which is the main concern of the Fed. Hi, MC. Good morning, Aaron. Good morning, Irfan. Glad to see y'all here this morning. Currently, we're trading at 403.60 on the open, so we're down just a measly 0.3%. With core PCE coming in at expectations, and given the decent couple week rally that we've seen going into this report, 1 week rally I should say, from 388 to 403. I think this is already priced in, given that core CPI and all the other inflation measures have already come in. I think this was to be expected. Good morning, the chosen one. Glad to see you here. Looks like the call credit spreads that I opened are doing well at the moment. Currently down $99. I ended up losing, I think, on Visa was the biggest loss. So I assumed that Visa would fall based on personal spending coming down in the latest quarter. But Visa was actually able to write in the previous quarter's revenue into this quarter's earnings report, which is very odd. But I mean, if that's, the scheme that they run, then you got to follow along with it, even if it is wrong in a sense. But yeah, I ended up losing on this one. I assumed that both revenue and earnings would come in worse than expected, and both of them came in actually much better than expected. So obviously, can't get every earnings right. And if we scroll down, let's see, trying to find the report of them carrying over Q4 results into Q1. Services revenue $3.5 billion, an increase of 10% over the prior year, recognized based on payments volume in the prior quarter. So, kind of shady business, but that's Wall Street for you. So, to be expected. What's up from Toronto? Oh wow, got some people international. See Robinhood, but you're using another platform. So this is Thinkorswim. This is the charting platform that I use, and then I use Robinhood to trade on. So this call credit spread is basically, or I guess put debit spread is what I open, basically at max loss. So no sense in really worrying about that. But we do have the call credit spread on the line. I originally opened these at 28 cents, 6 of them. Currently, they're going for 24. Again, I still think that we're going to be neutral today, if anything. So maybe we could do an iron condor just to give us a little bit more safety in terms of adding to or improving the risk-reward ratio on it. Right now, the risk-reward ratio on this is roughly like 3-1, right? So they're going for, I got them for 28 cents of credit, which means that I'm risking 72 for each one. So I could reduce the risk reward or the overall risk for this trade by doing a put credit spread on top of this. My only issue with doing a put credit spread is there is the Michigan economic report that's coming out at 10 a.m. and I'm not sure how that's going to impact the market. So maybe after 10 a.m. I'll take that trade just to have some sort of confirmation. But for right now, I'm just going to leave it as is. Hi, Aaron from Mexico. Wow. Mr. Worldwide. But yeah. And then I opened this AMD put that's doing well because Intel ended up missing on their earnings by a pretty decent margin. They're currently down 10% after their earnings. It came in at 0.1 earnings per share versus 0.2 is what was expected. So more than a 50% miss in terms of their earnings per share, which obviously is not a great signal for Intel and other chip maker names, AMD, NVIDIA, especially those growth companies. I think are going to get hit a little bit worse by this because these AMDs, NVIDIAs, they were expected to grow, who knows, like 30, 40%, 50% a year. Now you have a lot of wealth being taken out of the economy because of the higher interest rates. You have the China risk going on with Taiwan, and all the semiconductor manufacturing companies are basically like all in Taiwan. So that could potentially slow growth for the future for 2023 and beyond. And I see this as a proxy for growth. So semiconductors basically run the world. Almost everything in our lives have semiconductors, like this microphone, the computer that I'm using, my phone that I make trades on. Your car has a shit ton of chips in it. So if these chip makers start to slow down, that ought to mean probably slower growth for the overall economy, especially in terms of like digital. But even physical items like cars, right, also require chips. So overall, I see this as a negative sign for growth for 2023. And looking at AMD, currently trading at 74, so it actually did rise a little bit, only down 1.5% compared to the 10% drop that we saw for Intel. And if we go to the yearly chart and compare these two, we'll look at, say, the last 90 days of trading. So what I can do is I can pull up a 90-day moving average. So I like to use moving averages in like very special use cases. I don't like to just have moving averages just to have them. Let's see, simple moving average. And we're going to make this 90. So we want to look at the last 90 days of trading, or the last quarter, basically, of trading, where it's gone since the last report. We'll just set it as a blue. I don't really care about the color, but it's a 90 moving average. The average price for AMD over the last 3 months since their last earnings report has been 67. Currently, it's trading at 74. So that means that there's a difference of, $7 or about 10%. Whereas if we look at Intel now, it actually went below the 90-day moving average. So Intel was trading at 30 versus an average of 28 for the last 90 days. So that was $2 on a $27 stock, about 7% off of its average. So if AMD and their earnings comes in line with that of Intel, then it could go either to the 90-day average in like best case scenario, or worst case scenario, it would go below the 90-day moving average like we're seeing already for Intel. So that is what you would call a sympathy trade. So a sympathy trade is two companies that are in the same kind of category, right? AMD and Intel are both chip makers. So whenever one falls, the other one usually trades in tandem with it, basically. Now, it's hard to say that AMD will fall as much because AMD is more growth-oriented, whereas Intel is this legacy company that's been around forever. And they're on the tail end of their growth cycle, whereas AMD is this brand new kind of infant, basically, in the chipmaker industry. I mean, they've still been around for like 20 years, but like after Lisa Su came around and a couple years ago, it's been a very much growth trajectory. Like they did 40% more revenue last year than they did the year before, right? So they've had extreme growth. Now, probably not going to have as much growth as the economy slows down. But I think there's a good chance that this comes down to the 90-day moving average at 67. So I have these put options still open. And if this trade works out as I expect it to, come down to 67, I bought the 75 puts, so these would be worth roughly $900 a piece. And I've already spent $360 on it. So, actually, let me see. Current price, AMD break even is 71. So my average cost was actually $400. So I am comfortable with that $400 risk. I don't want to put any more up. But yeah, maybe we could diversify into NVIDIA earnings, but I think that's still a couple of weeks out. And NVIDIA is definitely trading well above the 90-day moving average. So that is an even better opportunity than AMD is if you're going to take on a short position for earnings, and specifically for chip earnings. So that is a huge margin, but their earnings isn't until February 22nd. So that is still, 3-4 weeks out from today. But, that's a sizable opportunity right there, assuming that it would come down all the way down to the 90 moving average. That's 40 points on a $200 stock, which is roughly 20%. So how do I feel about trading weekly options as opposed to daily? I like the daily options because they give you the ability to trade any event. So if I wanted to trade the Michigan economic report that's coming out in 20 minutes, I could do that. Or if I wanted to trade based on GDP coming in yesterday, I could have set my expiration date for yesterday. So I think that the daily options is probably better suited to my kind of trading style. Day trading, maybe not so much though, because I am very much, I think my edge whenever it comes to trading is data, economic data specifically, and swing trading. Although, like if we go to my drive, you'll see that I've lost a shit ton of money day trading because I feel like it's more technical analysis based, which is something that I still need to work very heavily on. Like if you go to my log, I've lost $32 on, All right, so I've made on average $12 for every swing trade that I've opened, and I've lost $30 for every day trade that I've opened, which has resulted in a total of $800 in losses on day trades versus $200 profit on swing trades. So I think my edge, personally, and everybody's going to have a different edge in the market, right? Like if you're studying technical analysis all the time, not something that I do, but if you do it, that's what you're going to get good at, and you would probably be better at day trading than I am. But for me, I'm better at predicting economic events before and after they happen. And, that's where I gain my edge, is swing trading and economic events. I started to actually tag my trades by just color coding them: economic data, earnings, technical analysis, fundamentals, or news. I just recently started doing this yesterday after I kind of wanted to find my edge in trading, just to really hone in on what I'm good at, to really dive deep into the data that I'm extracting out of this. Hopefully this will become a lot easier for me once it becomes automated with the app that I'm developing, but for right now, this is all I've got. So we'll have to deal with so. But let's see. Currently, looks like we're losing a little bit of value on the AMD puts possibly, and then the call credit spreads for SPY are going for 26. So these are losing a little bit. Let's see. Only up $6, $12 now. I opened these at 28. I think I want to wait for the Michigan economic report. Let's see. SPY. And I think that the Michigan economic report is going to confirm fears of stagflation, but I don't know if that's going to be the headline that comes out of it, because not a lot of journalists are talking about stagflation. I'm not sure if that's because nobody knows what stagflation is. I mean, I'm sure that, economic journalists should know what stagflation is, or I don't know why they would be kind of hiding that narrative. But basically what stagflation is when you have moderate growth or no growth in the economy, and then you also have inflation persisting at, 4 or 5% like we're experiencing right now. So I think that's very troublesome for the economy. That means that the overall populace has less money, less buying power, basically, because goods are getting more and more expensive still. You're seeing less economic spending in the meantime, right? Spending was down 0.2% month over month in the month of December, which is usually one of the hottest months in terms of spending, just because of the holiday season. So very interesting to see that moderating. And I think really that leads to stagflation. And in order to get out of stagflation, you have to go through a recession. To get rid of inflation, the cycle has always been inflation, stagflation, recession. And the longer that the Fed keeps doing these, 25 basis points halting, or 25 basis points pausing, 25 basis points pausing, the longer that stagflation is going to persist. So I think that's very troublesome. If the Fed does a 25 basis point rate hike for this quarter, I would rather them front load the interest rate hikes than, wait and kind of see. I think that would be a better approach, but obviously I'm not a Fed member and I don't get to vote, so who cares about my opinion, right? When do I think this bear market rally will end with the Fed meeting? I think that it could end with the Fed meeting if the Fed decides on the 50 basis points, or if Jerome Powell says that we're going to keep raising interest rates. So what the markets expect right now, if we go over to the FOMC countdown tool, these are going for 30 cents each now, so starting to break even on them. But if we go over to the FOMC countdown tool, this is what the bond markets expect of the Fed. So when they expect them to pivot, basically, when they expect the rates to stop going up. So right now there's a 98% chance, according to the Fed futures, of a 25 basis point rate hike. The Fed almost always, actually they always have followed this for the last 60 years. So odds of them going with the 50 basis points is very, 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 very low. Like, I'm talking less than 1% probably. So, given that, the next rate hike is supposed to be another 25 basis points. So we're going from 4.5 to 4.75 in March. And then I think that's when it's expected to peak. So they're going to stop raising interest rates according to the Fed futures in May of this year. In June, they're expected to still be at 4.75, so no rate cuts yet. And then in July, again 4.75, so no rate cuts yet. No rate cuts in September, but possible rate cuts starting in November, right? So they're going from that 4.75 mark to now 4.5, supposedly starting in November, in the last quarter of the year. I'm very doubtful that the Fed will pivot towards the end of the year, unless inflation is 2%. I think that the Fed needs to continue to keep interest rates the same and not begin to lower them until they get inflation down to their target. And if they do it preemptively, I think inflation will just shoot right back up. All right, we're going to 405 on SPY. It's currently 9:48, so we got about 12 minutes until the Michigan economic report, but that is a new 2-day high. Let's see if there's any name or any news. President Biden names former COVID aide Jeff Zients new White House chief of staff. Non-news. No big news coming out that's sending the markets up. So definitely a technical breakout, I would say. If we look at the studies, just the basics, I'm sure that, let's see. Go to RSI and MACD. So yeah, RSI is well above 70. Doesn't necessarily mean that there's going to be a pullback, but that is overbought. I would think if we do get a sentiment shift, it would probably be at 10 a.m. whenever the Michigan economic report comes out. So I think I'm going to hold into the Michigan economic report and test my luck with it. So again, my assumption for the Michigan economic report is that it's going to confirm stagflation. So what we want to see in order to confirm my stagflation theory, if we go over to the economic calendar, so this is the Michigan economic report. They do inflation expectations. So this is the 5-year inflation expectations. Last month it came in at 3%. Michigan consumer expectations is how the consumer thinks that the economy is going to do in 1 year out, which came in at 62 versus, or is expected to come in at 62 versus 59.9 last month. The consumer sentiment, which is the gauge of how consumers feel about the economy right now and how they'll feel in 1 year, is 64.6 expected, which would be up from 59.7 last month. And then the Michigan current conditions is how they feel about the current economy. So they expect this to come in at 68.6 versus 59.4 last month. So all of these numbers are much higher than they were last month. And I don't think that we're going to see that much improvement in consumer sentiment for the month of January, in my best guess. And then you have inflation expectations expected to come in at 4.4. So this is 1 year inflation expectations. Last month was 4.0. I would imagine that would actually come in lower than expectations. Probably along the lines of like, well, if it came in at 4% last month, I would expect it to probably come in at 4% again this month. Maybe slightly higher at like 4.1, 4.2, but not as high as 4.4. So it's going to be lower than Michigan net inflation expectations for 1 year. Then you got pending home sales, not really too relevant in today's market. But these are the big four that you need to look at, or five, I guess, that you need to look out for. Inflation expectations, 5 year and 1 year. Consumer expectations, consumer sentiment, current conditions, and yeah, that's all. So we'll see how it comes out. We got about 8 more minutes. We might end up going all the way up to 406.10 in the meantime. That's what the trend is looking like right now at the moment. I would imagine we would get rejected at 406.10, but hard to know. And given that today is Friday, we're going to see a lot of back and forth too. We're going to see a lot of volatility on Fridays just because there's a lot of options that expire on Fridays, which means that the market makers are going to push and pull the market in different directions to try to get everybody out of their options. That way they don't have to deal with exercising and assigning those options. But yeah, currently stalling out at that 405.46 high for today. But if we're looking at RSI, definitely a bullish start to the day. Starting at 9:30 this morning, it's been above 50 the whole time. So definitely bullish in terms of technical analysis. I would say it's still bearish in terms of the economic data that came out. And there's more economic data to come at 10 a.m. in about 6 minutes. So still holding. All right, 405.35. Let's see what else is going on in the market. Another thing that I wanted to touch on was the fundamentals. Today are both showing signs of us going down. So the 10-year Treasury yield is up from yesterday, 3.495-ish at close, currently at 3.53. And then if we look at the dollar, the UUP is marginally up, but still up nonetheless at 27.47 versus a close of 27.42 yesterday. So marginal gains on the dollar, pretty substantial gains in terms of the 10-year Treasury yield. So that means that borrowing is more expensive, that the dollar is more sparse, which usually ends up bringing stocks down, especially growth stocks. So QQQ could be the better short today rather than SPY. Currently, it's trading at 294.30, so rallying with the rest of the market, I guess. And then the next resistance level I have is not until 299, so maybe we could assume that it would come back to break even, which would be 293, but you're not going to get a good risk reward out of that, I would think, since it's only $1 away. If we assume that it'll come below close at 292, that might actually offer a decent risk reward, actually. Let me check it. AMD's only down 0.5% now. But looking at these Q put debit spreads, assuming we go back under 292, we're at 294 right now. So assuming back to 292, you're paying roughly 34 cents each, which I would rather get them for under 30 if I were to make this trade. So I'll skip on it for right now. Got about 4 minutes until the economic data comes out, though. So prepare yourselves one direction or the other. Am I already profitable? For the call credit spreads, I think they're at a small loss at the moment. Today is down. From the Visa especially, that's max loss. Yeah, $0 on these left. And then the call credit spread's still waiting on. Assuming under 406 today, currently they're going for 37. Originally opened them at 28. So since I opened 6, currently down $48. So we shall see what this Michigan economic report has for us in store in about 3 minutes. Oh, year over year, year to date, I would say I'm negative for this year. Last year, I was up by roughly 60%. So this year, so far, year to date, since the beginning of January, I've lost, I think, like 600, if I remember right. No, 500 so far, excluding the options that I've yet to close, but yeah, once I finish today, we'll have I think today would be the last day of the trading. But yeah, so far down 500. Last year, I ended up making roughly $6,000 in profit with around $10,000 of capital that I used to trade options. So this year started out with $7,000 of capital. So reduced my exposure. Currently paying for an app, so I needed to take out some cash. But down about 7% year to date on the options, which usually ends up swinging violently back and forth. Something that I think I need to work on probably is getting my win rate up. Last year, I had a win rate of between 70 and 80%. This year, I feel like I've become complacent with a 50% win rate, since my average win was larger than my average loss. So I'm going to try to get that back up to like 70, 80%. That's when I saw really the biggest gains. Was when my win rate was, very high up, 70, 80%. If we go over to the stat spreadsheet, we can compare my worst months, June, July, August. Win rate was 59%, 36%, 60%. And then my best months, February through May. And then in September, win rate was 80% in September. February through May was 80%, 78%. 88%, and then 78%. So roughly around 80% each time. So the higher my win rate, generally, the more profitable I am. But I feel like I've become, again, complacent and thinking that a 50% win rate is okay. So that is some room for improvement. All right, so we just got the Michigan economic report. No big move out of this yet, interesting enough. Investing.com. Go to the economic calendar. All right, so Michigan economic report. Consumer expectations actually rose to 62.7 versus 62 expected. 64.9 for consumer sentiment versus 64.6 expected. Wow. These Wall Street estimates are getting very accurate all of a sudden. Current conditions 68.4 versus 68.6 expected, so very close, but a marginal miss. And then inflation expectations actually dropped to 3.9% versus 4.4%. So that actually I could spin as probably positive. Both the 5-year inflation expectations and the 1-year expectations came in lower than expected, much lower than expected, and actually down from the month prior. So I think this could actually be a positive report. Currently, we're seeing a pullback for SPY on the initial. Pretty big candle, though. 404.50 to 405. So I think maybe we could head up to 406 given the RSI. I think that kind of confirms that we're bullish at 70 right now. So I think I'd rather take the upside trade. Maybe assume that we'll go to 407. So both the technical analysis and the reports kind of confirm this, which is a double win for SPY. So might actually end up being a green day for us. But yeah, looking at the if we do a 407, 408, that's going for 30 cents right now. I'd say there's a decent chance we go above 406. Still have the call credit spreads open, so I can't open the 406, 407 strike prices. Right now I'm down 60 for that option. So I think we exit those, take the opposite. Right now they're going for 42 though. So they're already priced for SPY to go to 406, right? Usually at the short strike price for a credit spread, it'll be worth around 40 cents each. For the long strike price, the one that you buy. So if it was trading at 407, these would be worth roughly 60 cents. So it's already priced to go to 406 right now, which means that I would be overpaying for it. So I think I'll hold off for the moment. We could do the 407, 408. That's going for 30 right now. And if we do end up going past the 406.10 mark to 407, those options would gain roughly about 30% in value. Currently, they're trading at 30 cents. And then if SPY were to hit 407, they'd be roughly worth 40 cents each. For this trade, probably wouldn't put a ton down just because we haven't made a decisive move just yet. So probably around 200 in risk that I'm willing to put down for it. 240 in risk maybe. And that'll kind of hedge to, I guess, the bearish position, the call credit spread position. So either way, we ought to make some money out of this. Now we're paying 31 cents a piece for these debit spreads. Got a credit spread at 408. Should I get out? I don't know. 408 is pretty far, but there's some chance that we go up there. I think this is going to really set us up for some pain on the next, what is it? The next Fed meeting, though. That is kind of concerning for me. If we rally too much, I feel like Papa Powell is going to be Papa Pain. Day trade alert. P1F. Just opened a new 407, 408 SPY called debit spread. This one expires today. So yeah, day trade 127 expiration, and I paid 31 each. Got the call credit spread at 408. Should I get out? I think that there's definitely some risk to the upside today. I would think we're probably going to head to 407. That's my base case. We're going to blow past a 406.10, probably reach 407 sometime by the end of the day. So those would probably gain, a decent 10 cents of value each between now and when we hit that 407 mark. So I'd be just keep caution on it, I guess. Not necessarily close it, because 408 is still up another, 0.5% from where we're trading now, but yeah. Nervous as hell. Yeah, aren't we all? Papa Powell will look at the data, which has to be positive, and give us a 25. I mean, the data isn't really positive if inflation is coming in 2 times what they wanted at. It's not a compelling argument, in my opinion. Like, if they want inflation at 2% and right now it's at 4%, that's like telling yourself, oh, I want to lose 20 pounds, but I'm okay with losing 10 pounds, which it's good. But, like, you're not reaching your goal in the end. When is Powell speaking? He's not until February 1st. So let's see what day that would be. So the 406, 407 call credit spreads are at 50 cents a value each. Currently at 126 loss, which I wouldn't be too mad about. So I think it's worth closing at this point. At least the 406. If you're going higher, like 407, 408, might be better. But don't think that I chose the right strike prices here, so gonna close. All right, so I had 6 of these that I opened at 28 cents a pop. Right now it's $130 loss. Oh, they just moved up to the ask price to 52. God dang it. No, they moved it back down to 51. All right, y'all need to decide on a decent bid-ask spread. And now it's at 55. Jesus Christ. Gotta love this market's volatility. We're at 406.50 though. Didn't get filled on this order. That's freaking annoying. But yeah, we definitely cleared that 406.10 mark. All right. I'll give y'all 52 cents each. That's the most I'm okay with. And of course, Robinhood wants to glitch out on me and tell me that I have 0 contracts. Robinhood really should fix that glitch. Super annoying. But yeah, closing options alert for that one. Discord. Coming in at expectations, that means the Fed is correctly predicting how much they need to raise rates to the. Well, they still expect rates to be at 5% by the end of the year, so. Closing options alert. Premium 101. Freemium. Oh, gosh. Just cut losses on the SPY 406, 407 call credit spread that expires today, 127 at 52 each. So ended up getting robbed as usual on Robinhood. Currently going for 49. But let's see. Originally opened those at 28 cents, I think. 406, 407. Opened them at 28. Opened 6 at 28. So 52 minus 28, 24 times 6, 144 on the loss. And still holding on to the other contracts The call debit spread's currently up. Nice little $50, so hopefully we can make up for the losses on that. I originally bought these at 31 cents. Currently, they're going for 41 cents. Didn't put a lot of weight onto this. Only bought 8, so I spent $2.40 with the potential to make, 70 times 8? Potential to make $5.60, and I think I would say pretty confidently we would be bullish, but again, it is Friday, so do expect some market volatility for sure. When is my expiration date for today? So this is a day trade. 127 expiration. But I would need it above 408 to make max profit. I think we could reach probably, let's see. Right now we're trading at 406. So maybe another half, like 407.30-ish. I don't know if we go to 408 though. Could have held to end of day for the 406. Not with the data that just came out and the technical analysis both pointing up. I think we could get a decent pullback, but the trend is definitely up today. Starting at 9:30 has been above 50 on the RSI. The PCE came in at 2 expectations, which isn't positive or negative, so that would be neutral. And then on the icing on top of the cake was the Michigan Economic Report showing lower inflation expectations and a good economy, according to consumers right now. Whether it's actually good or not, that's up to the interpretation. But yeah, I think I'd rather hold this one to the end of the day than the call credit spread. Seems more likely trade. Pending home sales came out. Actually positive month over month, 2.5% versus negative 0.9% expected. So people are buying homes now that mortgage rates have reeled back a decent 1% from 7 to 6%. So more demand, more aggregate demand for homes. I still think that there's too much supply for homes to go up in value though. Praying we don't get too silly. I don't know. The markets love to overreact to positive data these days, it seems like. Full ported my account into 408 credit spreads. I don't know. Today, Fridays are tough days to trade credit spreads, I would say. The risk reward on them is just too low. Let's see what the fundamentals are telling us though. So the 10-year is still up. The 10-year is actually, let's see, gone up since the report at 10 o'clock. Looking at the dollar is still about the same price that it was before, so no change there. But IWM definitely seeing some rally. IWM was lagging the rest of the market, I guess. Yesterday, QQQ ended the day at a high, whereas IWM didn't reach the morning high that they had. Interesting enough. Positive news and home sales is bad for inflation. Yeah, that's somewhat true, I would say. But that also means that people have more money to spend, which is negative for inflation. Battlefield out here. Yeah. All right, looks like we came below that 406.10 mark, so still going to hold until maybe we go below 50 on the RSI. Again, I'm still expecting bullish based on the report, based on technicals this morning. Seems like up and away for us today. Oh, no. Yeah. Unfortunately. I know the Bears are probably upset with it, but you gotta go with whatever the data tells you. It doesn't matter if you're bearish or bullish and how you feel. It's all about how the data comes out, which could be manipulated in one way or another, but it is what it is. Still holding AMD. I'm still holding the AMD put option, not the shares that I owned back in June. The only shares that I'm holding is, let's see, I've been dollar cost averaging, so I'm not all cash right now. Been dollar cost averaging into these three Fulgent, Tesla. I got a free partial share of McDonald's. I actually kind of want to add to staples. Might not be a bad idea. Staples like McDonald's, Coca-Cola. What else? Walmart would be a good one. Those would be decent plays for a recession. But yeah, I got Tesla, I got Fulgent that I've been buying $100 a weekend. Kind of hesitant to buy 100 shares of Tesla right now since it's trading at 165, but it is dollar cost averaging, so it doesn't really matter, I guess, in the end. Currently up 121 or 17% on the dollar cost average shares. But yeah, I'm going to buy $100 worth. Really don't want to buy it whenever it's trading, up, a good 20% this week. But part of dollar cost averaging is buying at any price. Wish I had dollar cost averaged before the earnings report came out, but you win some, you lose some. So buy alerts. Just bought 100 of Tesla. And then what percent loss do I generally close spreads? I don't really have a set percentage or anything. I usually close them based on more so on sentiment. So today, my sentiment initially was bearish to neutral, which is why I ended up taking that call credit spread at 406, 407 yesterday. That was the next price level up. But then after the Michigan economic report came out, that ended up changing my sentiment to being bullish. So that's why I ended up closing out on it rather than setting a specific price target or whatever. It's more based on sentiment shifts for me. 140%. Yeah, I mean, you might be able to wait it out. We could see a decent pullback to probably like 405.5, and you'll be able to take a smaller loss on it. But yeah, definitely still above 50 on the RSI, so I think we're still going to be bullish in terms of technicals and in terms of the news today. If it hits your strike price, that's one way to do it too. Like you could say, once it hits my short strike price at 406, then I'm out. Might be a decent idea. With how volatile the markets move up and down these days, I would say it's kind of hard to pull that off. And usually the credits that you get aren't that great with credit spreads these days, just because the volatility is so low, but it's also high enough to where, you're going to get, you're going to reach that 406 mark that I set very quickly, like we just did, right? It only took us, 35 minutes to get there? Do I think stocks will rally until Tuesday, then drop on February 1st? I think there's a possibility that they do drop on February 1st. I think that Fed Chair Powell will probably be more stern or more hawkish than he usually is, but I do think that they're going to go with the 25 basis point rate hike. So the 25 basis point rate hike would be bullish, but it is to be expected given that there's like a 99% chance, right, of a 25 basis point rate hike. So it should be already priced in. So it really boils down to what is Fed Chair Powell going to say? Is he going to give us any projections for the end of the year? Is the Fed going to start to cut rates at any point during the year? If he does say anything that signals that the Fed is going to stop raising rates, that would be very bullish for the market. But if he doesn't hint towards it at all, I think that would be bearish. And given that I would say Powell is one of the most hawkish, he does have the loudest voice since he's a chairman, so that does kind of sway more emphasis to what he says, but I do think that he's more on the hawkish side than he is towards the doves. So I would think we would see a decent pullback on February 1st. Now, that is about 4 days out, so what did you say, Tuesday or Wednesday? Yeah, Wednesday, February 1st. Yeah. How many contracts would be silly on a credit spread? I usually do anywhere from 5 to 10 these days. I only put down it depends on how much risk you're willing to put up, right? So what is your account size? And I wouldn't risk probably more than 5% on any given trade right now, at least. Once things get more volatile, then I might increase that. But with a VIX trading at 18 or 19, whatever it is right now, I would be keeping my positions small and maybe taking on more bullish type of positions like leaps and poor man's cover calls to make income off the leaps like I did for GLD. But choose the right company out of it. You don't want to choose just any willy-nilly company and expect, I don't know, Tesla to go up 20% in a month, even though it has. It's very unlikely that would happen, right? So I would rather put leaps on more certain investments like gold, bonds, Staples, McDonald's, Walmart, etc. Things that people still need during times of recession would be better than these high growth names that have been shit on for the last year since the interest rates started to grow up, because their growth is going to be more impacted by the interest rate hikes than a company that's as well established like Walmart that's just going to keep getting customers in the door no matter how high interest rates are. He can't afford a big rally to fight inflation target. That's true, partially. Do I have a hard stop loss like 40 Delta? No, not usually. I don't have any hard stop losses. I think that hard stop losses can really kind of ruin your gain sometimes, especially with options and how volatile they are. Like an option can go from a spread option can go from 20 cents value to 80 cents value on its expiration date, like very quickly, depending on how far away you are with your strike price, right? I would base it more so, again, on sentiment shifts like I like to do, and then maybe price levels, like that 406 price target is where I ended up closing out of the call credit spread, the 406, 407 call credit spread. I think that would be a better method than just setting some hard stop loss and always monitoring your trades if you have time for it, right? I monitor my trades almost every hour of the day. I don't check my phone like every 5 minutes, but probably every hour of the day I'm looking to see what my contracts are valued at. And then like if it's above and I think it's going to persist above that 406 price level, then I would get out. All right. Looks like AMD made its way back up. No, barely negative. It was back up to positive slightly earlier. The Visa is at 230. AMD's at down 25 cents. What is Intel doing with this rally? It's down 7.3% now instead of the 10% that it was down earlier. So I guess the rest of the market is kind of pulling a magnet up for Intel right now. But I still think that there's a decent drop in store, especially for NVIDIA. How do I trade the Fed meetings? Usually I'll trade them the day before, and I'll do a swing trade around it. Or if there's like a huge discrepancy between my expectations for the meeting and where we're trading right now, like with SPY trading at 405, definitely on the upper end of the last 3-month range, I would probably take the negative on it. Right? So, the narrative is that the Fed can't, have this rally and fight inflation at the same time. I'm not sure if that's necessarily true, but it does make sense if people feel richer, then they're going to spend more money. But we did see consumer spending moderating in the last month. So if we continue to see that, then that would be, I guess we don't have that much data coming out before February 1st. But, yeah, I would probably take the downside on it. We're at 60 on the RSI, so RSI tells us bullish. But I think if they do the 25 basis points, that's already priced in that we're going to get 25 basis points. We've rallied from 376 to 405, so that's 30 points, around 7% from the lows, right? 330 over 405 is, 7%. That's not a huge rally, I would say. Like, if that was somewhere along the lines of like 10, 15%, then I would say, yeah, clearly we need to give the markets a good old slap in the face. But I think they'll do the 25 basis points. If they do the 50 basis points, that would really kind of kill the market. That would probably send it down a good, I don't know, like 4% at least. Which would be 405 times 96%. That would bring it down all the way to 388. But I think probably he's going to come out hawkish. He's still going to be playing the role of, the hawkish Fed member, super stern, and wants to get inflation down, which I think is going to be taken as a negative still. So I would say it would probably drop around 2% from where we end the day before, though. So where do we go between now and next Tuesday is the next question. All right, so I would say actually we can look at the probability scale. So what we would be looking at January 31st. It's expected, SPY is expected to go up or down by $5 in either direction. So the top of the market should be roughly 410. Let's see if there's any more economic news that's coming out, though. Economic calendar. Next week's. Got bond auctions. You have nothing really major coming out Tuesday. Employment cost index. That might actually have some weight to it, but I'm not sure if it'll... It's definitely not going to have nearly as much weight as the Fed meeting on the 1st. So I would say the top for next week would probably be around $410. Maybe if we go up another couple dollars today to like 407 or whatever, we end the week at like, or we're at like 412. So we'll do 412. We'll say that it'll come down 2%. That would lead us to roughly 404. I would imagine we'd pay a decent bid for that, though. And it might be better to wait it out until we are trading closer to 410, 412 than opening it right now. Because if we decide to open it right now, we're paying 43 cents in credit. Let's see. 43 cents in cost, which isn't bad, considering it's only $2 below where we're trading right now. But I'd be kind of worried about the continuation of this rally up to like 408, 410. So maybe we open this closer to the end of the day than we open it right now. But for right now, still holding on to the options that I had earlier. So the 406, 407 call debit spreads. Still expecting SPY to go up today. Again, based on the technicals, above 50 on the RSI. And based on the Michigan Economic Report, where consumers expect inflation to moderate and for the economy to be doing well. They think the economy is going well right now. So given that kind of sentiment, I think we're probably going to go up today. Still looking for that 406.10 mark. And I probably want to close out of these call debit spreads if we go maybe above like 407.10 or 407.3 would be the mark I'm looking for. Kind of wish we had more price levels to go off of. Maybe we can pull one from the 1-year chart, but not 100% sure on it. So we're looking for 403, probably 403.10 from this gap right here. Might be a decent mark to look for. So I'll create an alert at 403.10 or 407.10 and try to close at that price. So once we go above that, I'll know and close out of this call debit spread. Again, it's 407, 408 strike prices that expire today. So we'll see how this shakes out, but that's all the trades that I got for today. The Visa trade is at max loss, so let me type in my trades before I head on out. Still got the AMD put option open. Still think that it's going to come down to the 90-day moving average. But this one will say that it expired at max loss. So paid 91 to open. They'll expire at 0 or worthless. The SPY call credit spread that we opened yesterday, we ended up closing at 52 cents a pop. And we closed those ourselves. Those did not expire. And then we opened new trade this morning, SPY put debit, which is call debit, I should say. Call debit, which is a bullish strategy. Expiration date is today, and strike prices we chose were 407, 408. I opened 8 of them at 31 cents each, or 32. Let me double check. $2.48. Yeah, 31 cents a pop. All right, so that is all the trades that I'll make for today. So January, pretty tough month, down $1,000 at the moment when rate was like 49%. So that's definitely something we need to work on for February. Getting that back up again to the 80% that I was seeing last year. That's when I was the most profitable. So probably focusing on better opportunities, probably staying away from day trading for the most part, at least, has been negative. But yeah, that's the end of the trading day for today. Still holding on to the 406, 407s. And once we hit 407.10, then I'll be out of this. And then I'll catch y'all on Monday. Don't think it's a holiday, so I'll catch y'all at 9:30 Monday. See you, everybody.